Welcome, everybody. My name's Ben. I'm with Stratas, and today we are breaking down the SBA 504. What is the SBA 504 loan program? The SBA 504 loan program provides long-term fixed-rate financing for owner-occupied commercial real estate and major fixed assets, including large equipment and ground-up construction. The program offers below-market fixed interest rates through a partnership between a bank and a CDC, Certified Development Company. With more documentation requirements and a longer underwriting timeline than conventional loans, it is designed to promote expansion, stability, and long-term owner occupancy. So what does this mean in simple terms? Let's say you are a business looking to purchase some owner-occupied commercial real estate, let's say an office building. So you want to get a 504 loan. So the capital provided in this loan is going to be split up in a 50-40-10 stack. So the way it works is 50% of the loan is going to be put up by a traditional lender, a bank, and they're going to use their current commercial lending rates. 40% of the loan is going to be put up by a CDC or Certified Development Company that's partnered with the SBA. The way a CDC works is they issue bonds to investors. Investors purchase those bonds. They use those funds to supply the capital for their 40% share, and the interest earned on that share from the borrower gets paid to the investors. This allows the CDC to remain nonprofit while the investors earn interest money on those bonds. The borrower gets access to very cheap capital because the interest rate is going to be based off the 10-year treasury plus a little bit of margin, so very, very low rates. And this in turn helps stimulate the economy and local communities through business and real estate development. And then finally, 10% is going to be put up by the borrower. Use cases. We really only have two main use cases for this loan. It's going to be owner-occupied real estate, things like offices, warehouse, manufacturing facilities, retail, and more. This isn't going to be for investment properties. It's not going to be for a fix and flip. It's not going to be for owner-occupied residential real estate. This is owned and occupied by businesses, and these are meant to be held long-term. And finally, long-term equipment financing like heavy machinery, production equipment, vehicles, technology, things that your business is going to use for many years into the future. Let's say, for example, you need a piece of equipment to help produce your product inside your manufacturing plant. Well, that's something you're going to buy and hopefully use for many years as long as it's still functioning. Let's talk terms. So the funding range for the 504 is going to be $100,000 on the low end and $16 million on the high end. So really, it's going to be able to fund almost any project for a small business. Term lengths, we're looking at 10 to 25 years. Typically, these are going to be 10-year, 20-year, and 25-year loans. And interest rates, let me break that down one more time. So the bank is going to supply, as you can see in the structure section, 50% of the loan. So 50% is going to be supplied by the bank, and they're going to charge their market commercial rate at the time. The CDC, however, that is issuing those bonds to investors, which is funding the 40%, which is gaining interest, paying back to the investors. They're going to use the current treasury rate. So the current 10-year treasury right now, it's at the time of making this video, it's 4.02% plus a little bit of margin. So you can see very, very competitive rates. So maybe we're looking at 6-7% at the most, plus the commercial rate. So you're essentially getting two loans packaged into one. It's going to be under one payment, but there's two different portions that are going to be articulated in your loan agreement. But combined, it's still going to be incredibly attractive. And then 10% of the money is going to be put up by the borrower. Now, sometimes we can do 0% down, but for the sake of this example, we're going to say 10%. And both of those rates are going to be APR or an annual percentage rate, meaning it's going to be charged on whatever the remaining principal balance is on a yearly basis. So if year one, the balance is $10 million, at a 10% interest rate, that's going to be $1 million worth of interest. If year two, the balance goes down to $8 million at a 10% interest rate, that's going to be $800,000 in interest. So let's check out our high-level example. XYZ business plans to purchase a $2.5 million owner-occupied commercial property. With the standard 50-40-10 split SBA 504 structure, the project is financed as follows. Bank loan 50%, $1,250,000, CDC loan 40%, $1 million, borrow equity 10%, $250,000. The CDC portion offers long-term fixed rate financing 10, 20, or 25 years, while the bank portion sets its own rate and structure. So sometimes the bank portion might have an adjustable rate. That's something to be aware of. This allows the borrower to secure a high leverage real estate purchase with stable long-term payments. In simple terms, a $2.5 million purchase with $250,000 in equity, the rest financed through the 504 program using the bank and a CDC partnership. So you can see very, very attractive loan here. Qualifications for the 504, we're looking at 650 or higher in minimum credit score. We're looking at an owner-occupied use of 60% plus, meaning you need to occupy at least 60% of the building. So you theoretically could rent out the other 40%. And if it's new construction, you have to start out at 60% at least, but within the next 5 years, the goal should be to reach 80% occupancy. And equity injection, meaning the amount of money you have to put up yourself, is going to be around 10%. Application process for this: company and signer information, basic information about you and your business, stuff that you should know off the top of your head, addresses, contact information, social security numbers, EINs, things of that nature, ID and ownership verification, front and back of your driver's license, and an EIN, documentation or articles of incorporation to verify your ownership of the business, last 6 months of your bank statements, last 3 years of your personal and business tax returns, personal financial statement, that's going to be a specific form from the SBA. And that form is going to be the 41.3D. Year-to-date profit and loss plus balance sheet for the business. Essentially, how's your business running this current year? And real estate documentation, information about the property, inspections, title work, things of that nature. All the things that you would expect on a normal real estate purchase. And then any existing loans that you have, if applicable, because that's going to obviously affect your ability to borrow. Average time to close. Our average time is going to be 60 days. The fastest we can get it done is 45 days. The longest is going to be 90 days, just depending on how complicated the deal is and how close you are to the threshold of being able to afford it. But I would say that 9 times out of 10, you're going to be in that 60 to 90 range. Conditions for new build, like I mentioned on the previous slide, you're going to start out with 60% occupancy. You need to occupy at least 60% of the building with the goal to reach 80% within the first 5 years. Number 2, personal guarantee. Like all of the products here at Stratas, anyone that owns at least 20% or more of the business needs to be signed onto this loan. Number 3, interest rate adjustability. While the CDC portion is fixed, you must be aware that the bank portion could potentially have an adjustable rate at 3 to 5 years. It'll adjust to whatever the current market rate is at the time. And finally, 4, early repayment penalty. This is a big one. Like I said, this is not for a fix and flip or sort of a short-term investment property scenario. You are going to pay early repayment fees, 5% first year, 3% the second year, and 1% the third year. So you're going to be locked in for the first 3 years unless you want to pay one of those penalties. For example, if you had a loan for $1 million, you sold in year 1 at that 5% penalty, you're looking at a $50,000 penalty. That is quite a lot to stomach. So something to be aware of when purchasing with the 504. Moving on to fees, the origination fee for us as a broker, we actually charge nothing for brokering this deal for you. So we do the whole thing for free. We get a kickback from the lender. And the lender is going to charge a pretty standard 1 to 5% of total value in closing costs. And that summarizes the SBA 504, one of the best products we have here at Stratas. If you're looking to purchase real estate, if you're looking to purchase some equipment, this is the way to go. The interest rate cannot be beat, especially on that fixed portion. So scan the QR code to get started, fill out the form, talk to one of our senior brokers, and they'll walk you through all the necessary steps to getting this 504 loan. My name's Ben. I'm with Stratas. Thank you for watching, and I'll see you in the next one.